You can feel it in the air, right? That buzz, that feeling that something absolutely massive is happening. And right now, it is all about AI. Everyone's calling it a once-in-a-lifetime opportunity, but I just can't shake this feeling of déjà vu. It feels a lot like 1998, back when the internet was the next big thing and everybody was dead sure they were going to get rich. And, well, we all know how that story ended. So the big question is this time really different, or is history about to repeat itself? The legendary investor John Templeton gave us this warning, and honestly, it's the perfect way to look at everything we're about to unpack. It seems like every generation thinks they've stumbled into a new era, a new paradigm where all the old rules just don't apply anymore. But more often than not, they really, really do. So let's keep this quote front and center as we dig into the AI boom. I mean, for a couple of years back then, it really felt like the party would never end. Valuations just went straight up. But then, in 2000, the music stopped. The bubble burst. The Nasdaq plummeted nearly 80%. And get this, less than half of the dot-com companies even survived. It was a brutal, brutal lesson in what happens when hype gets way ahead of reality. So, are we seeing those same warning signs flashing today? All right, to figure that out, we're going to break this whole thing down. We're going to look at three kind of hidden forces that might be driving a bubble. First, the AI arms race, then a really weird financial loop that I'm calling the money machine, and finally, a potential roadblock in the future known as the data wall. And most importantly, we are going to finish up with a clear, no-nonsense playbook for how you can navigate all this potential chaos. Okay, let's dive right into our first warning sign. It's all about concentration. I mean, the entire fate of the stock market right now is basically being decided by just a handful of companies, and they are all locked in this frantic, high-stakes race to completely dominate artificial intelligence. Now, what's really wild is the sheer scale of this concentration. Just 7 companies, you know the names: Amazon, Microsoft, Alphabet, Meta, Apple, Tesla, and of course, NVIDIA. They make up a staggering 36% of the entire S&P 500. So think about that. Even if you just own a simple index fund, you are already making a huge, huge bet that this whole AI race pays off big time. And the size of that bet is just mind-boggling. These 7 companies are on track to pour $330 billion into AI in this year alone. Just let that number sink in for a second. $330 billion. And this isn't spread out either. We are talking about absolute giants like Amazon dropping $100 billion, Microsoft $80 billion, and Google $75 billion, all to basically rip out and rebuild their entire infrastructure around AI. They're spending whatever it takes because in their minds, if they move too slowly, they're not just falling behind, they're out of the game entirely. To try and wrap your head around $330 billion, consider this. It's more than the entire economic output of a country like Finland or Portugal. All of that cash is flowing into building the future, this so-called fourth industrial revolution. But here's the flip side. It also means that without this insane level of spending, our economy might already be in a recession. So all this massive spending brings us to our second and, maybe the most concerning warning sign of all. It's this strange financial loop that some people are calling the AI money machine. And it raises a really critical question. Are we looking at real growth here, or just some clever financial engineering? So how does this machine work? It's surprisingly simple, actually. Picture this. Microsoft gives a ton of money to OpenAI. Then OpenAI immediately turns around and gives that money right back to Microsoft to pay for cloud servers. Microsoft then takes that cash and buys a mountain of chips from NVIDIA. And then, to complete the circle, NVIDIA invests its profits back into the very same AI companies that are buying its chips. It's this perfect loop where money just goes round and round, and everybody gets to book it as revenue, which of course helps push their stock prices higher and higher. And this analogy just perfectly illustrates how absurd this could be, right? If you and a friend paid each other $1,000 to dig and then fill the exact same hole, you'd both have revenue on the books, but did you create any actual value? Nope. And that's the big worry with this AI money loop, that it's just artificially inflating demand and creating a kind of phantom economy. This gold rush analogy just sums it all up. NVIDIA's selling the shovels, the essential chips. Companies like Oracle are providing the land, the infrastructure. And AI labs like OpenAI are out there digging the quarry. Everyone's making money helping to get the gold rush going, but here's the crucial point. Very, very few have actually struck gold yet in the form of real sustainable profits. So, look, the critical point is this massive gap you see right here. Just take OpenAI. It's valued at a staggering $500 billion, but its revenue is only around $12 billion, and it's still losing money every single month. This is the heart of the problem. Will these companies ever make the kind of profit that's needed to justify these sky-high stock prices? And that question brings us to our third warning sign. See, so much of today's insane valuations depend on one single belief, that AI's progress is just going to keep accelerating at this breakneck speed. But we might be about to hit a very real, very fundamental limit. The question is simple, but it is profound. For the last few years, AI models have been absolutely devouring every scrap of public data they can find, books, articles, the entire public internet. But what happens when it's all gone? What happens when it's all been consumed? This slide really puts it into perspective. AI has basically inhaled centuries of human knowledge in just a few short years. Some projections suggest that by 2027, AI models will have been trained on pretty much all human-generated online content. The well of public data is running dry, and when it does, progress could slow down dramatically. So can AI overcome this? Yeah, potentially, but it might need a fundamental shift in how it learns. See, we humans don't just learn from being force-fed data. We learn from interacting with the world, from our experiences, from our mistakes. For AI to scale past this data wall, it might need to move beyond just consuming data and find a way to generate truly new knowledge on its own. Now, let's be really clear here. This is not exactly like the dot-com bubble. These AI companies have real products and a much clearer path to making money. But when you take a step back, the classic signs are all there. You've got massive overvaluations, financial flows that look a whole lot like faking revenue, this geopolitical mania driving a spend-at-all-costs mentality, and very real questions about scaling limits. So after all of that, what's the right move? What should you be doing with your money? With all this uncertainty, it is so easy to feel like you should either sell everything or go all in and bet the farm. But the smartest path, as always, is somewhere in the middle. So here's a simple playbook for how to approach this whole situation. It really just comes down to three core principles. First, keep investing and ideally do it automatically into a broad, low-cost index fund. Don't try to time the market. Second, focus on what you can actually control, increasing your own income. And third, and this is crucial, make sure you are properly diversified. Diversification is your best defense against a bubble popping in any one specific area. And that just means spreading your money across different kinds of assets. So a portfolio might have stocks, sure, but also bonds, real estate, maybe even some precious metals. The key is just not to put all of your eggs in the AI basket, no matter how exciting and tempting it seems. And honestly, this is the most important takeaway of all. The real secret is to not panic. If, or more likely when, your portfolio goes down, it is not the end of the world. For investors who have a plan, who aren't over-leveraged, a market crash is one of the greatest opportunities to build long-term wealth by buying quality assets when they're on sale. Which brings us right back to that huge central question. The truth is, nobody knows for sure. We could be staring down the barrel of the biggest bubble since the year 2000, or we could be at the very, very beginning of a transformation as profound as the internet itself. The key is to be prepared for either outcome, and that preparation starts with understanding the warning signs we've just explored.
Please subscribe and like.